I think gold is going to break out this month. And that quick spike did make a new high, but it didn't last more than a few minutes. But this time, I think it'll be sustained. I see gold going to 3,000 in this period where we have a stock market melt up. So in the next six, yeah, and I've said I think the stock market probably peaks before gold does prior to the bust. But my pre-bust target, whether it's middle of the year or push it a little further than that, my pre-bust target for gold is 3,000. And then I think it gets hit with every other asset during the bust. So maybe it does a round trip, goes from here to 3,000 back to 2,000. I'm not sure. And silver, I have a target of 60. And silver's a lot harder for people to buy because it's lagged a lot. And it's been many years where people have been frustrated by its disappointing performance. But I think it's going to outperform gold as it always does in a bull market. And I think you're going to see silver as the dollar heads for 80 go to 60. And I've said it lately that I would not be surprised if silver actually went as high as 75. So that's a tripling, more than a tripling from here. But my target is really 60. But I think there's room beyond that if it wants to go. And again, that's a pre-bust target. So that's the next 6 or 8 months. And then I think silver obviously will get beat up more than gold in a bust. So silver might go to 60 and it might come back to 25. I don't know.
Sure. Just want to go back to this inflation question again for a moment. If we look at it in terms of national debt, US debt, we're piling on. It's not slowing down. And the interest cost of the national debt in the US is significant, to say the least. The only way that the US can deal with this is effectively inflate away the debt. Now, is this where we get a bit of a policy mistake because you're saying that they stay higher for longer, and as a result, potentially lose the opportunity to inflate away the debt?
Yeah, here's how this is crazy, but that one of the triggers that might happen to trigger the bust, it's the ultimate over tightening that causes it. But there's a possibility. Let's say we got this equity melt up. If Jay Powell sees the equity market above 6,000, never mind 7,000, he's going to go bananas. I mean, he bought into Bill Dudley's thesis of April 2022, hook, line, and sinker. That's why they spent the next year after that trying to jawbone the market down. Every time the market went up, out came his minions talking about, they're going to tighten more. They're going to really hit this hard because they wanted the market down. They really bought into Dudley's view that the market rallying makes their job tougher, means that financial conditions are loosening, not tightening. So imagine his mindset if he sees the S&P above 6,000. He's going to say, we can't cut rates. We can't ease. We got to tighten. You may be at a point because the market's thinking they're looking over the trough. They're saying, the Fed's going to ease. So the cycle, we may not even have a recession, or if we have a recession, it's going to be mild. We're looking past that recession. And the reason we're going to 6,000 or 7,000 is because we're starting to factor in better earnings in 2025. We're starting to factor in the fact that we're going to have a recovery in earnings, in 25, 26. And we may actually be on the verge of recession at that point. So let's say we're in spring, early spring of 2024, and Powell's looking at the market above 6,000, and he's saying, "I'm hiking." And his committee says, "We're hiking. We're not." That could be the real negative surprise, certainly for the markets. But I think it also could be if you're already making a policy mistake because of the lags of over tightening. That could be, they may be hiking rates on the eve of a recession that could be a pretty bad one, and they're focused on the more stock market. They don't realize how close they are to, the market rolling over and the economy rolling over. So that may be the thing that kind of ticks the top. And they may, and again, they may be doing sort of like in the Great Depression when the central banks were making moves that were basically, they should have zigged and they zagged. That may be what the central banks do this time around, is tighten right on the eve of recession when they should be saying, "Oh my goodness." So if that happens and we tip into a bust, as I said, I think this could be worse than 2008-9 in terms of financial problems. In October of 2008, when Lehman failed and GE almost went under because the commercial paper market froze, right? They almost didn't have access to the liquidity they needed. The government and the Fed acted pretty fast to free things up, or else we would have tipped into a bust, I think. So that's the difference between 2008-9 and what I think this time is. This time I think we tip into that bust. And what I mean by a bust is a free-falling financial system that they can't stop easily. That means you're going to see dominoing of bank failures, and they only have one tool that can move quickly and have any impact, and that is money, right? Yes. You will see more money be pumped out from every central bank, from every corner of the world, because it's going to be global. And I can only talk to the Fed's, or I talked about the Fed's numbers, but I believe the balance sheet right now is say 8 trillion or a little below. I don't know where it is exactly, but got up to 9 trillion. The Fed's balance sheet. I think the Fed's balance sheet before this is over, in response to the bust, will be in excess of 30 trillion. So they'll be printing over 20 trillion in new money in QE. As much as Powell says today, we're not doing that again. We'll never do that again. We're trying to get away from that. When you got a free-falling financial system, they're not going to be sitting there worrying about inflation. They're not going to be worrying about the long-term effects of this. They're going to be trying to save the system. And that's true of the ECB. They'll be doing proportionally the same thing. Japan's going to be doing something like that. Bank of Canada, Australia, People's Bank of China. Everybody's going to be trying to save the system. And again, there are these leads and lags. By the time they do save the system, by the time they stop the free fall, they've gone way, way too far. And next thing you know, in the second half of the 2020s, 26, 7, 8, 9, you'll have jump-started an inflation cycle that will make the early 1980s look like a picnic. I think you'll see 25% inflation in this country by the end of the decade. So what you said before about servicing the debt, I mean, our interest costs today are a trillion, and which is larger than our military budget, and that's at interest rates that are 5% or 4%, or their average cost is probably below that. What happens when their interest costs are 15% on the way to 20? There's no equation out there that can solve that. And I think you get the depression in 2030s as a result of that. And that depression in 2030s, I think, comes with an entire collapse of the Western, or basically the worldwide financial system. I think no government's going to be able to service their debt. There's going to be, 50% unemployment with no government to support you. That's what I think is coming in the 30s. And it becomes, all this builds up to this, but it's been building for 80 years. I mean, it's every cycle we had more excesses and more excesses. And it took more to bail us out of that cycle to the next one. And we're reaching what I call the end of a Ponzi scheme. You finally reach that point where it comes apart.
You don't paint a very rosy picture, do you?
Well, depends on which time frame you use.
Yeah, exactly. Okay,
yeah, I don't say this lightly, because it's easy to talk about, but it's going to be really dire, I think. And I keep telling people, focus on this year and between now and the end of the decade, because there will be great opportunities in commodities post bust. I'm calling for $500 oil by the end of the decade. I'm calling the reason we have 25% inflation is because that money leads to a lot of money chasing a lot fewer goods.
Sure.
And those goods, it's going to be an industrial recovery more than a consumer recovery. So those goods are, the commodities. So ag commodities, gold, copper, silver, all the, industrial metals, natural gas will go through the roof, oil go to $500. So it's, there is an opportunity on the other side of the bus. It's just not going to be in tech stocks or in growth stocks. It's going to be, or indexes. It's going to be in commodity-oriented stocks or commodities. And I tell people, you've got basically between now and the end of the decade to get your financial house in order, because those that do are the ones that are going to have the best chance to survive what happened in the 2030s. It's don't stay, as much as it sounds horrible and you want to think about it, try not to focus on the 2030s because it's so far out. Things can happen. I could be wrong. I'm painting a picture of what I see coming together, but the time to focus is this next 6 years.